Welcome back to The Explainer. Today, we are diving straight into the biggest social media settlement in history. Meta just wrote a check so massive, it literally dwarfs the entire market cap of some major companies. But here's the wild part. When the news dropped, Wall Street totally shrugged it off. The stock, it barely moved. So we're going to unpack exactly why that happened and what this actually means for the engine driving Meta's future. Let's get into the real financial narrative.
$16.7 billion. That is what Meta just agreed to pay. It is an absolutely eye-watering number, right? Usually, when a company gets slapped with a regulatory fine this huge, you'd expect sheer panic. Shares tumbling, analysts freaking out, the whole 9 yards. But as you're going to see, the market's reaction here reveals a completely different, much deeper story about where this tech giant is actually heading.
To really get a grip on this, we'll quickly run through the settlement itself, check out the new operational changes, figure out why Wall Street shrugged, look at the real driver, AI capex, break down the bull versus bear case, and finally, flag the key dates you need to watch.
All right, starting with part one, the $16.7 billion settlement.
Let's just lay out the facts. Meta hammered out an agreement with 29 states over claims that Facebook and Instagram were explicitly designed to hook younger users. The states were arguing that Meta used addictive algorithms, had weak age verification, and really downplayed the mental health risks to teens. But look closely at that headline number. The absolutely crucial phrase here is up to. This massive financial hit, it's spread out over multiple years, and a good chunk of these payments are completely contingent on future factors. So the guaranteed upfront cash out the door is actually a lot lower. Even the Meta hasn't given us the exact breakdown just yet.
And here is a massive detail from the legal text. It explicitly states Meta admitted no wrongdoing. Now, I know that's standard corporate legal playbook stuff, but it is huge in this context. It means Meta isn't legally admitting their algorithms caused any harm. Holding that specific line is a game changer for their other legal battles, because conceding fault here would have set off a massive domino effect in jurisdictions all over the place.
Moving on to part two, inside the operational changes.
Because honestly, the dollar amount isn't the real story. It's how these platforms are going to work from now on. Meta agreed to some foundational operational shifts that are going to introduce some serious friction for users. We're talking a hard 2-hour daily time limit for teens. Sure, parents can override it, but it puts a huge speed bump in front of endless scrolling, which naturally eats into ad inventory. Then there's a strict midnight to 6 a.m. block on notifications and content. That basically kills late-night engagement for that whole demographic. Add in the enhanced age verification protocols across the board, and you've got real, tangible changes to how younger audiences interact with Meta's core products.
So, part three, why Wall Street shrugged. With all that friction and a massive fine, why did the stock initially pop 4% pre-market and then basically end the day flat? It all comes down to scale. Just look at the absolute maximum cost of this settlement, that's $16.7 billion over several years, and put it right next to the $50 billion in free cash flow Meta raked in during 2023 alone. Suddenly, the panic completely evaporates. To the street, this historic fine is essentially just a manageable operating expense. The institutional guys had already priced this in. They knew a state-level settlement was coming. They were just waiting for the final price tag.
In fact, top analysts like Mark Mahoney over at Evercore ISI actually saw this as a win. He called it a catalyst that removes a major legal overhang, and Evercore even reiterated their $860 price target. From where it's trading right now, that's roughly a 30% upside. The logic is pretty ruthless but simple. Isolating this state-level risk finally clears the runway for uninterrupted earnings growth to take the spotlight again.
But we definitely need a reality check here. There are still about 3,000 active lawsuits out there from school districts, families, and individual plaintiffs. So yeah, the state-level regulatory risk is boxed up and budgeted for, but Meta's overall exposure to civil litigation, absolutely not cleared. Those 3,000 cases are going to keep burning through legal resources in the background for a while.
Which brings us to part four, the real driver, AI capex.
Because what's actually moving the needle for the big institutional investors isn't the settlement. It's artificial intelligence infrastructure. When you stack that headline legal fine next to Meta's AI capital expenditure plans, everything just clicks. Meta's gearing up to drop a mind-blowing $130 to $145 billion on AI data centers, servers, and chips in 2026. To put that in perspective, that is more than double what they spent just 2 years ago. We are literally comparing $16.7 billion spread over years to around $140 billion in a single year. That unprecedented spending, that is the real elephant in the room. And pouring that much cash into infrastructure leads right to the billion-dollar question that's currently squeezing Meta's free cash flow margins. When do we actually see a return on this massive AI investment? Mark Zuckerberg has basically been saying 2027 and beyond. It's like they're building the world's most expensive toll road, but investors are sitting there drumming their fingers, waiting for the cars to show up. On Wall Street, patience is running super thin. People are aggressively demanding tangible proof that this build-out is going to pay off.
Let's look at part 5, the bull versus bear case.
This exact tension has split the market into two totally different camps. Starting with valuation, right now, Meta is trading at around 21 times forward earnings. That's sitting pretty comfortably below its 5-year median of about 28 times. If you're a bull, you're looking at this as a huge bargain, a rare discount on a massive tech giant. But if you're a bear, you see this as a show-me valuation. That discounted multiple is heavily weighed down by deep skepticism about whether all that AI spending is actually going to work out.
So let's break down the arguments. The bulls are screaming from the rooftops that the core business is absolutely crushing it. I mean, ad revenue shot up 27% year over year last quarter. Plus, Instagram Reels and that AI-powered ad targeting, they're clearly working, driving up engagement and ROI for advertisers. And now that massive state-level legal cloud is gone. That's why analyst consensus is still a strong buy, with an average target of $755. A solid 32% upside. Conversely, the bears hit back hard. They argued that this AI capex is just a $140 billion black box with zero clear timeline for returns. If the AI monetization falls flat, this stock is going to get re-rated way lower as those margins compress. Add in those 3,000 active lawsuits, which are still a huge wildcard. And remember, unlike the old tobacco companies, Meta can't just hike prices forever to cover their legal bills. Plus, global regulators, especially in the EU and the UK, are breathing down their necks. Honestly, both sides make a really solid point here.
Finally, part 6, key dates to watch.
Ultimately, which of these narratives takes over in the next 12 months is all going to come down to execution. So here's your watch list. First up, you've got to tune into the next quarterly earnings call, and you're listening specifically for any solid updates on direct AI revenue. Second, keep a really close eye on their capex guidance. If management hints that capital expenditures are finally peaking and starting to level off, that'll be a massive green light for the stock. And third, watch the legal wires for any major movement or class action certification on those 3,000 pending lawsuits, because that could easily spook the market again.
So taking a step back, this historic $16.7 billion settlement really is a net positive for Meta. It clears out a huge amount of state-level uncertainty and just proves they have the cash to take massive legal hits without missing a beat. But it is definitely not the main event. Meta's future is entirely tied to how well they execute on AI. The current valuation might look like a steal for long-term players, but volatility is pretty much guaranteed while the market digests this wild AI spending and the ongoing legal noise. So it all boils down to one final question. Looking at all this data, are you buying the dip, or are you sitting back and waiting for a little more clarity?